Okay, so why don't we start? Welcome, everyone. My name is Diego Kanzig. It's a great pleasure today to welcome you to today's webinar, which is part of the Young Scholar webinar series on climate change, macroeconomics, and finance, organized by the E-Axis Forum. Today, we have Tristan Jourde and Quentin Moreau, who will present their paper, Systemic Climate Risk. This paper was awarded honorable mention for the 2024 E-Axis Forum Research Prize, so many congratulations for that again. Let me also introduce the speakers. Tristan is a research economist in the Financial Stability Directorate of the Banque de France. He previously worked in asset management, holds a PhD in financial economics from the University of Paris-Dauphine, and his main research interests are in climate finance, asset pricing, and systemic risk. Quentin is an assistant professor in sustainable finance at the Hong Kong University of Science and Technology. He obtained his PhD in finance also at Paris-Dauphine, and his research interests are mostly in sustainable finance. Okay, so without further ado, please, Tristan, the floor is yours. We're very excited about this, and you have 45 minutes, and then we'll have time for Q&A.
Okay, thank you very much, Diego, for the great introduction. We are very pleased with Quentin to have the opportunity to present our work at this webinar. So since it's quite late in Hong Kong, for Quentin, I will be the one delivering the presentation. And just as a side note, the usual disclaimer applies. So I will start by briefly introducing the topic. Then I'll spend quite some time detailing the framework. And finally, I will review the main results of our paper. So as a brief introduction, as you may already know, Mark Carney, the former governor of the Bank of England, was among the first in 2015 to warn that climate change could become an issue for financial stability. And since then, the potential systemic implication of climate risk has become a central concern for the financial community, even if it's remained an unsettled debate. So we think a good illustration for that is the fact that most regulators have joined the Network for Greening the Financial System, the NGFS, in order to share the best practices on how to manage climate risk in the financial sector. So in this chart, we summarize the main assumptions that underlies our framework. So the main idea, and I think it's quite consensual, is that climate risk, both transition risk and physical risk, will first affect the non-financial economic sectors. This can go through different channels, like a reduction in business income, or even a business interruption, or damages to property. And only then financial institutions might be affected through their portfolio exposures to the non-financial economic sectors. There are different types of portfolio, of course, can be equity portfolio, credit portfolio, or even insurance contracts. And we call that the first sworn effect of climate risk on the financial sector. Then once some financial institutions have been affected, there might be some amplification or contagion effect within the financial sector due to the strong interconnection network between financial institutions. And we call that the second one effect of climate risk on the financial institutions. Finally, if some banks stop lending to the economy, there might be some feedback loop to the real economic sector. But this is out of the scope of the paper, so we focus on the three circles on the right. So the main objective of the paper is to build a market-based framework that is able to capture both the first one and second one effect of climate risk on the financial sector. So regarding the first one effect, which goes through the decrease in the value of the financial portfolio of individual financial institutions, there are already some papers examining this issue, such as the one of Jung, Engel, and Berner that designed the C-risk indicator for banks. So the main originality of the paper is that we built a procedure that can capture the second one effect also, which can also be called contagion effect, and which encompass common exposures, spillovers, and pure contagion. So here a caveat is that we are not able to disentangle between these different channels of contagions. Finally, another advantage of our framework is that it can be applied to all types of financial institutions. So the key question we try to answer in our paper are which are the most vulnerable financial institutions? Can climate risk lead to contagion effects among the financial institutions? And finally, is it possible, both for financial institutions and policymakers, to implement some measures in order to mitigate the climate-related financial risk? So now let me give you some intuition behind the fact that we use a market-based framework to study this issue. The main rationale is quite simple. It's the fact that climate risk should lead to repricing of basically all the securities in financial markets, and most of them are held by the financial institutions themselves. So in the paper, we first want to assess whether climate shocks are reflected into the price of the non-financial sectors, and whether this shock then propagate to and among financial institutions. So in a way, we take the point of view of an investor, and we look at whether the price climate risk as a systemic risk for the financial system. And one advantage of our approach is it can be used to derive some dynamic indicator in order to monitor this effect. So in that way, our framework, we think, complements the more forward-looking approach of the regulator, such as climate stress tests that are based on long-run scenarios and are also subject to more uncertainty. So here we summarize the main steps of the framework. So first we design two variables, a systemic risk measure for financial institutions and some climate risk factors, one for transition risk and one for physical risk. Then we'll use these variables into a regression framework to test for potential systemic climate risk. And finally, we are interested into whether financial institutions and regulators have some levers to mitigate the climate-related financial risk. So we will study a broad range of determinants of the previously estimated individual exposure of each financial institution to climate risk. So the paper contributes to three different strands of the literature. The first one is a growing literature, rapidly growing literature on the integration of climate risk into asset prices. So most of this literature try to estimate whether there is a carbon premium or not in the equity market. So here our framework can be used to check whether climate risks are reflected in the tail risk and co-movements of the equity market. The second and probably the main contribution of the paper is on the literature on the effect of climate risk on financial stability. So as I was saying, the existing papers only focus, at least for those that derive some market-based measure, only focus on the first one, effect of climate risk on the financial sector. And we introduce this framework that also capture for the second one effects. And finally, there is this literature on the characteristics and the reaction of the firms that are exposed to climate risk. So here, our contribution is first to focus on financial institutions and also to study a broad range of determinants of this market-based measure of exposure for financial institutions and potential adaptation measure for the financial institutions that are the most exposed to climate risk too. So now I'm going to review the main steps of the framework, starting with how we build our systemic risk measure. So we want an indicator that captures the tail risk within the financial sector, basically. And we want to distinguish between two key elements of systemic risk, which are individual tail risk on the one hand and contagion effects on the other hand. So for individual tail risk, we use the stock returns of the financial institutions, and based on the Gash model, we derive a dynamic value at risk for each financial institution. Then we use a PCI analysis in order to extract the covariation between the change in tail risk of all the financial institutions together. Okay, and we use the first principal component as our main systemic risk indicator. So this indicator is related to the rest of the literature, like the paper of Adrian and Bruder-Meyer regarding the delta covar indicator. But it has this specificity of distinguishing between individual tail risk and contagion effect, which is key for the purpose of our study, which is to differentiate between the first one effect of climate risk on the financial system, so on individual tail risk, and the second one effect of climate risk on the financial system, which is on contagion effects. So here you can you have an illustration of our main systemic risk indicator, which again account for the common variations in the tail risk of the financial institutions. And as you can see in the chart on the left, the indicator tend to spike during the main systemic event that occurred over the past decades in Europe, because we'll see that later, but our sample is focused on European financial institutions. So it reflects the global financial crisis, the Eurozone crisis, the Brexit referendum, and the COVID-19 outbreak. And in the chart on the right, you can see the percentage of the variance explained by each of the principal components. So the first principal component captured 27% of the variation within the database, which is in line with other papers that use principal component for individual financial institutions, like the one of Bilio and co-authors 2012. And as you can see here, the other principal component only marginally increase the percentage of the variation that is explained. So we consider that the first principal component is able to capture the systemic risk variation, basically, or at least most of the variation in the system. But we'll check for that later on in the robustness checks by considering all the principal component together. Another important element for our measure of systemic risk are the loadings of each financial institution on the first principal component, which we interpret as the individual contribution of each financial institution to systemic risk. And in our main regression framework, we will use that in a cross-sectional regression, and that will provide a complementary test. So now I will explain how we build our climate risk factor for the non-financial corporations. So they are supposed to capture the effect of different type of climate shocks on the value of the non-financial corporations. And again, we want to disentangle between transition risk and physical risk. So we will have two climate risk factors. So to do that, we use a standard approach in the empirical asset pricing literature, which is to build some long-short factor mimicking portfolios. So the idea is that we are going to sort the non-financial companies into two portfolios. So for transition risk, we'll sort them into a brown and a green portfolio based on their carbon emission intensity and a specific quantile. And for the physical risk, we will sort the firms into a vulnerable and a safe portfolio based on individual physical risk score, which is provided by Trucost. So then we just compute the difference of returns between the two portfolios to create our BMG factor, which is related to transition risk, brown minus green, and our VMS factor related to physical risk, which is the vulnerable minus safe. Finally, since we are interested into extreme climate risk, we derive a tail risk version of those factors based on the same methodology that we have used for the systemic risk indicator. So we use a Garch model to derive a dynamic value at risk, and we think this is appropriate to capture the potential uncertainty in the pricing of the green and brown stock during in case of a climate shock. And we want to check whether our factors are able to reflect different type of climate shocks that would be related to transition risk and physical risk. So for the BMG, for the transition risk factor, we regress the returns of the factor on different climate news indicators provided by Ardia and co-authors 2023. So first we used the aggregate climate risk indicators, and then we also used two climate news indicators that are related to transition risk, which are the business impact and the societal debate. Finally, we also test the effect of the Google Trends related to climate change on the factor. And as you can see in all cases, it's an increase in climate news leads to negative returns in the BMG factor, which means that the brown stocks tend to underperform the green stocks in these instances. For the physical risk factor, we run the same kind of exercise. So we regress it on natural disaster damages that we get from the EMDAT database. Again here for Europe. So first we use the log of the disaster damages adjusted for inflation, and then we also design additional dummy variable based on different thresholds of the damages. So we use the 100 million threshold, 500 million threshold, and 1 billion threshold. And you can see it's quite interesting that when the threshold increase, like meaning that larger damages seems to have larger impact on the physical risk factor, and it's a negative impact, meaning that the vulnerable firms tend to underperform the safe ones.
Sorry, just a clarifying question.
Yes.
What's the frequency here? Like, what is T? Is it daily? Yeah, what's the frequency?
No, it's a monthly frequency. And as control variable here, we use the 5 FAMA French factors. Now that we have built our two kind of variables, we use them into regression frameworks to test for systemic climate risk. So we'll do the following. There are we introduce a two-pass test procedure. So the first test is quite simple. We just run a time series regressions of the variation in our systemic risk indicators on the climate risk factor, and we add some control variables, of course. And we use a complementary test, which is a two-stage regression framework, which is related to the FAMA-MAC-based approach, but we are not interested into the estimation of carbon premium here, but we want to check whether climate risk can lead to an increase in tail risk and co-movements in the financial sector. So I will come back to that later in the presentation, right before the result. I think it's going to be easier to understand everything. Finally, we are interested into the characteristics and the reaction of the financial institution exposed to climate risk, because we want to evaluate whether both financial institutions and regulators have some levers to mitigate the systemic climate risk. So we will look at some financial characteristics associated with exposure to climate risk, both the size and the leverage of the firms. We'll look at environmental characteristics, both at the country and at the firm level. We look at the ownership structure of the financial institutions that we will consider to be a proxy of long-term orientation for the financial institutions. And then we will look at potential adaptation measures and disclosure of the firms that are the most exposed to climate risk. Okay, so now a few words about the data. It goes from 2005 to 2022 for the members of the European Union, and we add some countries that have many financial institutions in order to increase the size of our sample. So at the end, we follow more than 370 financial institutions, their stock returns, that belongs to different subsectors. We have some banks, both life and non-life insurance companies, financial services companies, and real estate companies. And in order to build the climate risk factor, we use a large number of non-financial European stocks. Just a word about the control variables. So we use standard macroeconomic and financial control variables, which have been found in the literature as potential driver of systemic risk. We have the default premium, the interbank market liquidity, the yield curve spread, and the economic sentiment. And since our framework use equity market data, we think it's a good idea also to control for systematic risk factors that have been proposed in the empirical asset pricing literature for the equity market. We have the size, the value, the momentum, liquidity, quality minus junk factors. There are a lot of them. And it has been shown in the literature that all those factors can capture different set of bad times, like the small and value from distress or the momentum crashes that could also lead to an increase in systemic risk in the financial sector. So now I will present some results for the individual exposures of financial institutions to climate risk. So here we just run n time series regressions for individual financial institutions in which we incorporate climate risk as a potential stress factor for the financial institutions. So here we regress our tail risk, individual tail risk measure, the dynamic value at risk of the financial institutions on our tail climate risk factors and the control variable I have detailed before. So we are interested into beta BMG for transition risk and beta VMS for physical risk, which represent the exposure of each financial institution to climate risk. So the idea here is that we aggregate those coefficients using the mean group estimator of Pesaran and Smith. And we estimate the regression dynamically, so we can check the dynamics of those coefficients over time. So what we can see is that transition risk is almost always positive and significant, and that the effect have been increasing over time. And for physical risk, we kind of see some kind of increasing trend also, but overall the effect is non-significant. Then we can run the same analysis, but by distinguishing between different types of financial industries. So here we see that the increasing trend is particularly strong for the banks and for the insurance companies, while for the real estate companies, for instance, the coefficient tend to be more stable. Okay, so now we turn to the estimation of the systemic climate risk. So again, we introduce a two-pass test procedure for this. So first we run a time series regression in which we regress our main systemic indicator, which represents the covariation in the tail risk among all the financial institutions, which is the first principal component, on our tail climate risk factor and the control variables. Okay, and we are interested into this delta BMG and delta VMS here. That's if they are positive and significant, which means that it can lead to contagion effect within the financial sector. So for the complementary test, which is a two-stage regression framework, we want to check whether the financial institutions that are the most exposed to climate risk tend to contribute more to global downside risk or systemic risk. So for this, we first need to estimate the exposure of each financial institution to climate risk. So we run the same regression I have presented you before. We run n time series regressions of the tail risk of financial institutions on our tail climate risk factors to get those beta BMG and beta VMS, which represent the exposure of each financial institution to climate risk. And then we use this coefficient as an independent variable in a cross-sectional regression in which we regress the contribution of each financial institution to systemic risk, which, remember, those are the loadings of each financial institution on the first principal component, on the exposure of each financial institution to climate risk and exposure to other risk factors. Okay, so in a way, the first stage regression captured the first one effect of climate risk on financial institution, while the second stage regression check whether the climate shocks can lead to contagion effect within the financial sector. So here are the results of those regressions. Again, BMG is for transition risk, VMS is for physical risk, and here we have also represented the coefficient for the market factor, which is useful for comparison purposes. So what we find here is that transition risk has a positive and significant effect on systemic risk, both based on the time series test and the cross-sectional one. While we do not find such evidence for physical risk. And something interesting, in the time series regression, we have standardized all the variables, so we can compare the coefficients. Okay, so what we can see here is that, okay, transition risk is positive and significant, but in terms of magnitude, it's still much lower than traditional financial risk factors in the literature, such as the market factor. Okay. In terms of control variable, we have the macro financial variables and the FAMA French factors. And as you can see here, the R squared of the regression time series is quite high, which is pretty reassuring that there is no issue of omitted variables here. So what I've presented you in the previous slide is a statistical test to test for potential systemic climate risk. But what would be useful for the regulator is to have an indicator of systemic climate risk that is able to monitor and quantify the first and second one effect of climate risk on the financial sector over time. So we derive this indicator based on our framework and also based on the work of Adrian and Bruder-Meyer that have introduced the delta COVA. So we call those indicator the climate exposure COVA indicator. I can come back to the detailed methodology if you want later on in the Q&A section. But right now, I'm just going to detail the result of this indicator. So here we represent the result only for transition risk, and it's supposed to capture the increase in the daily value at risk of the European financial sector, which would be associated with a relatively substantial transition-related shock. When I say relatively substantial, this is a shock that is expected to be exceeded once a month. So it's not too extreme here. So what we can see is that overall there is some kind of increasing trend in our climate exposure COVA indicator, reaching a peak in 2022 at 15 billion euros for the global European financial sector. And another interesting thing is that, as you can see, the second one effects in red used to be quite limited in the first half of the sample, and then they have become dominant in the second half of the sample, which can be due to, again, it encompasses common exposure, spillover effects, and pure contagion. But so it can be due to the fact that most financial institutions have become positively exposed to climate risk here. And another interesting thing is that our indicators become negative after 2016, which coincide with the first policy of Donald Trump in the US. So now we check for the firm level characteristics that are associated with the transition risk exposure of the financial institutions, which might provide some insight on how to mitigate climate risk exposure overall. So for transition risk, we find quite interesting results. So first, we find that the larger financial institutions tend to be more exposed to transition risk, which is in line with some results of the ECB climate stress test, showing that the most polluting companies tend to engage more with larger financial institutions because they are large firms, basically. Also, we find evidence of that climate risk could interact with financial vulnerabilities. Here we see that the level of leverage is positively correlated with the transition risk exposure of the financial institutions. And finally, we look at many different environmental characteristics that could be associated with the transition risk exposure. So first, we find that the greener the financial portfolio of the financial institutions, the lower the exposure to transition risk. We also find that when those Scope 3 emissions have been verified by a third party, it leads to a reduction in the exposure to transition risk. And the same goes when the financial institution have reached its reduction target. So then we introduce two different proxies for the long-term orientation of the financial institutions. So the first one is a dummy, which is equal to 1 if the board members have compensation for addressing long-term issues, and the other one is capture the institutional ownership, so the percentage of the capital of the financial institution that are held by institutional investor, which tend to be long-term investor, which put more interest into potential long-term issues. And we find that in both cases, this lead to reduction in the exposure to transition risk. Next, we look at the country level characteristics that are correlated with the individual exposure to transition risk. So here we look at the financial institutions that are domiciled in specific countries, and we look at the country level characteristic associated. So we find that when the country has a high use of renewable energy and low emission overall, so we use different type of variable to capture those low emission, even either a dummy variable that focus on the bottom quartile, either we take the emission per capita or the log emission, we find the same result, that it tends to decrease the level of exposure of the financial institution to transition risk. We also look at the effect of the implementation of ESG mandates on the global exposure to transition risk of the financial institution based on the staggered indifference approach. So here we find something interesting, find that the implementation of those policies tend to decrease the exposure of the financial institution, but only for the above median exposed institution, which actually is the goal to decrease the level of exposure for the most exposed institution. And we find no effect for the institution with the below median exposure. So overall, it states that the increased transparency or regulation that aims to increase the level of disclosure, and we are not talking here about potential capital requirements or anything related, already can have a positive impact on the stability of the financial system by reducing the level of exposure of transition risk exposure for the financial institutions. And finally, we look at some adaptation measures that the financial institution most exposed to transition risk could take to maybe to decrease their level of exposure in the future. So we look at different things. So in the first and second column, we look at financial institution disclosure. So integrated strategy is a dummy variable that is equal to 1 if the financial institution integrates extra financial factors in its annual report. And discuss climate risk is also a dummy variable that takes the value 1 if the annual report discusses business risks that are related to climate change. Okay, so in both cases, we find that the financial institution most exposed to transition risk tend to disclose more information about ESG and climate issues, which is actually in line with another paper in the literature of Campbell and co-authors 2014 that have shown that the firms that are more likely to disclose information about a risk when they are materially exposed to this risk. But another interesting thing is that here we look at a specific section in the annual report, which is a management discussion and analysis section, which is known to be a quite flexible tool for firms to disclose information. So we think that it might raise some suspicion of a greenwashing by financial institution. Of course, we do not want to be too assertive about this fact, which would need further investigation, but we think it's still worth mentioning. Then we look at the impact of the exposure to transition risk to the carbon offsets. So we find something intuitive that it tends to increase the level of carbon offsetting by the financial institution, but the effect here is non-significant. And finally, there are some concern among the financial community regarding potential regulatory capture by the financial institution most exposed to transition risk. And here in column 4, we find evidence against this issue because we find that the financial institution most exposed to transition risk tend to engage less with the policymakers on possible responses to climate change. Okay, so now we turn to physical risk. We do not find that many significant results for the physical risk exposure. Still, we find that in contrast with transition risk, the financial institution, the largest financial institution, tend to be less exposed to physical risk overall, which we think might be due to the fact that physical shocks tend to be quite localized in specific areas, and large financial institutions might have the ability, a better ability to diversify their activities among different areas. Also, we find that overall, the degree of transparency of the firms tend to be rewarded and lead to a decrease in the exposure to physical risk overall. As before, we look at country level characteristics that would be associated with the physical risk exposure. So here we look at we find that the financial institutions that are domiciled in the countries with a high risk of floods, a high number of deaths related to climate change, and a high dependence to external water resources tend to be more exposed to physical risk. And also as a robustness check here, we try to focus only on a sample of financial institutions that have a strong home bias, and we report even larger and even more significant coefficients. Finally, we look at potential adaptation measures for the financial institutions that are the most exposed to physical risk, which even if it's not that's significant for currently, it might become material in the future. So we consider that the financial institution might already take action to face it. So here we look at the effect of being exposed to physical risk on the fact of having an environmental management team, also on on a dummy variable, which is equal to 1 if the financial institution have at least one product line or one services that is designed to have positive effect on the environment. Sorry. And finally, we look at this variable, which is called climate scenario analysis, which take the value 1 if the financial institution have conducted a climate scenario analysis for its portfolio of financial assets. Okay, and basically in all cases we find that being more exposed to physical risk leads to an increase in these 3 dimensions. So we consider that it means that it incentivizes financial institution to run some proactive risk management initiatives. So now let's turn to the robustness test. So I think a very important robustness test is to check whether the results are robust to alternative version of our climate risk factors. As you may know, there is this whole debate in the literature on the carbon premium regarding the robustness of the result to the use of different specification of the carbon emissions. So here we propose to build alternative version of the transition risk factors using a different type of specification of the carbon emissions. So we use different things. We use the lagged carbon emission intensities, scope 1 and 2. We used only the scope 1 reported carbon emission intensities, and we also use the unscaled emissions, so the absolute level of carbon emissions. And in all cases, we find robust results. So that lead to the same conclusions, which is interesting because for the carbon premium, it seems to have a huge impact on the result, but for the tail risk of the equity market and the co-movements, it doesn't seem to matter that much. Then we also use alternative version of the Garch model to derive the value at risk, both of the financial for the financial institution and for the climate risk factors. Another important thing is that our transition risk factor could be affected by the dynamic of the oil prices. And we want to control for that. And so the simplest way to do that is just to include the oil returns in our main regressions, and we find robust results overall. Another way to do that is when we build the climate risk factor, we just remove all the firms from the oil sector first, and then we build the climate factor with the other firms, and again we find significant results. Forgot to mention, but for the physical risk factor, we also test different variables to build them. So instead of using the individual's physical risk score from Trucost, we use those from ISS ESG and from Carbon for Finance. And in all cases, we find non-significant results. Then we also use alternative estimation methods. So one interesting thing is that by using weighted least squares instead of OLS and providing larger weights to the most recent observations, we find the same result overall, but the coefficients are higher and more significant for transition risk, which is in line with the fact that the transition risk have been increasing over time. The effect of transition risk on the financial sector have been increasing over time. Then we also deal with potential issues based on the moderate sample size and the non-normality of the series using a bootstrapping approach. And in the second stage regression, we account for the error in variable because we use a pre-estimated coefficient here by using a shrinkage approach, which lead to similar results. I said before that we try to account for the information of all the principal components, just to be sure that we are not losing important information that could be in the second principal component or something else. So for that, basically we run the second stage regression, but as a dependent variable. Instead of taking the loadings on the first principal component, we take the average correlation coefficients of each financial institution with the other financial institutions. So it's an average of all those correlation coefficients, and this correlation matrix is supposed to capture the information of all the principal components. And finally, we run a placebo test. So the idea of the placebo test is that our result might be due to some noise, in particular in the transition risk factor. So one way to check for that is to rerun the result between 1990 and 2005, a period over which the awareness to climate risk was quite low. So we run this analysis and we find non-significant effect of our transition risk factor on systemic risk, which I think is pretty reassuring. So now I just jump to the conclusion. So we build this market-based framework in order to first identify the financial institutions that are the most exposed to tail climate risk, and also to detect whether climate risk can lead to contagion effect among financial institutions. So we find that only transition risk affect the level of systemic risk in the European financial sector, while we find no such evidence for physical risk. Again, it's over the period considers 2005 to 2022, and from the point of view of investors. So it's quite important to build those climate risk indicators, I think, and to monitor how the effect can evolve over time. The good news here is that financial institutions might have some levers to reduce their exposure to transition risk, and actually to physical risk too. So for transition risk, they might just try to green their financial portfolio or trying to increase their degree of transparency. And also by adopting a longer term orientation, they seem to be able to mitigate their exposure to transition risk. For physical risk, the main thing would be to try to diversify the activities across different areas, since most of them seems to be quite localized. Finally, we want to stress that the framework is quite flexible, so we have derived it based on the approach of Adrian and Bodermeyer to build this systemic climate risk indicator that is able to distinguish between the first and second one effect of climate risk on the financial sector and to monitor that over time. But it can also be used to different countries.
Tristan, sorry, can I ask you to wrap up? We want to have some more time for questions. Sorry.
Yes, for sure. It can also be used to other countries, sectors, and asset types. And overall, we think it can also be used to assess the effect of other emerging risks for financial stability, such as cyber security risk and biodiversity risk. So I'm done here. So thank you very much for your attention, and we look forward to the Q&A and your comments.
Fantastic. Thanks so much, Tristan, for a very clear and engaging presentation. Also, with all the robustness checks already covered, you have already answered many of my questions, but let me maybe open the discussion, asking a bit more big picture question. Is it a right characterization of your work that, like, to the extent that this systemic risk may not be priced in financial markets, your estimates are sort of a lower bound? Because, I mean, that's a bit the distinction between risk and uncertainty, right? On many of these events, we may not have a well-defined probability distribution because we don't really know what could happen potentially in the future. And that may not be accurately priced in financial markets, right? So your approach would have a hard time getting at that.
Yeah, I totally agree with that. I mean, it's a lower bound, but the nice thing with the approach, and especially with the systemic climate risk indicator, is that we can potentially check for much more extreme climate shocks. But you are right that there is a lot of uncertainty around climate risk, and this is why we consider that this monitoring is quite important, as we hope that it could provide like a warning signal before some extreme climate shock happens and destabilize the financial system. So we hope that the forward-looking characteristics of the financial market and of investor could be useful even for the regulator.
That's great. And then maybe one more clarifying question, because before I open it up, is on the result on physical risk, because in the rolling regressions, I mean, it seemed there were some significant effects that were just negative and no positive, at least at the beginning. Were you just referring that the average effect is insignificant, or like how should we think about this?
Yeah, I think it should be sort of as an average. Yeah. So of course it evolves over time. As I was mentioning, there seems to be an increasing trend. And actually our systemic climate risk indicator for physical risk, like in 2018, there have been a lot of winter storms, and actually it is positive and still it can reach quite high values. But yeah, overall, as an average effect over the period 2005 to 2022, it is insignificant. But for
Great.
sure, yeah, if we wanted to focus on specific periods like maybe 2019, 2022, or even 2024, we could get different results. Yeah.
Fantastic. We also had a question of one of our panelists, Olympia. Do you want to ask your question yourself?
Hi, thank you so much. Thanks for the presentation. I was just wondering whether your analysis allows to disentangle the risk that arises from the underwriting portfolios of insurers and the role of reinsurance within these dynamics. Thank you.
Thank you for this question. No, unfortunately, we are not able to disentangle the different channels for contagion, at least as the methodology stands for now. Yeah, so first we would love to be able to disentangle between the common exposure, spillovers effect, pure contagion, but of course there are other channels that are specific to the insurance sector that would be great to be able to take into consideration in the framework. But I think it's quite tricky in this type of framework, which are based on equity market data, to integrate or disaggregate to this point the results. Maybe Quentin, you want to add something on that one?
On that point, no, not really. I think you are quite complete. Maybe we come back to the earlier question of Diego. I think we were searching for some explanation actually with Tristan a while ago about this negative, coefficient for physical risk, and actually it's quite established in the insurance literature that when you have more natural disasters, you could have what is called gaining from losses. The fact that you have severe disasters, and because of that you have more insurance take-up. So maybe that's what we capture with negative coefficients for some period.
Very interesting. Great. There are also some questions in the chat, so let me maybe go to these. Pascal, he wanted to follow up specifically on the effects of transition risk for banks, and basically is asking whether it's possible for you to know whether the risk metric, this transition risk metric, is dependent on the own scope 1 and 2 emissions of banks or their borrowers' emissions.
So yes, so the question is about the when we check the effect of the characteristics on the exposure to transition risk, which type of carbon emission scope do we use, right? So we use the scope 3 emissions here because we think that this is like the most significant part of the carbon emissions, at least from a financial stability point of view for the financial institution overall and banks included.
Yes, and maybe to add to that, actually, once again, we try to find some reference for that, and we found a study from this non-profit organization, CDP, Carbon Disclosure Project, and they had found that roughly for financial institutions, the scope 3 from investment was something like 700 times higher compared to scope 1 and 2 emissions, because most of the emissions of financial institutions are through this investment activity.
Great. Then Pierre has a question. I think it's related to one I asked before, basically on the extent to which risks are priced. So he's asking, could it be that if markets do not price in physical risks, then systemic risk indicators based on stock market data like yours will not capture potential systemic risks? In other words, systemic risk from physical risk will materialize when physical shocks become larger than now and start affecting stock prices more.
Yeah, I think it's a very, very interesting question. I mean, our framework is derived from this empirical asset pricing literature, which is based on systematic risk and not directly on systemic risk. So systematic risk is a risk that cannot be diversified away, while systemic risk is a risk that has the potential to destabilize the financial system, which would require some kind of extreme shock. So here, first, we consider that in some of our regression, we focus on this beta coefficient, which I think is quite interesting because it's the exposure to any type of shock. Then you can just model different magnitude of shocks and try to see what would be the impact on the financial institutions. Yeah, but at the same time, there is all this uncertainty component and potential extreme shock, and here we like modified the standard empirical asset pricing model to try to capture the uncertainty in the pricing of the brown and green companies due to climate shocks. And to take into account potential extreme effect. Okay, so that's how we try to deal with this systematic component. But it's true that if the physical risk of the physical shocks are very localized, so first, it might be quite difficult to capture them even as a systematic risk factor. Based on this type of methodology. And then that might be the reason why many event studies are able to find that local physical shocks have effect on local financial institutions, including banks, while it's harder for us to find anything based on the global European financial sector.
That's true, but in the future, like these physical risks may become more correlated across time and space. Indeed, like if you look at the frequency of extremes, that has increased quite a bit on many margins. But yeah, I think that's a fair characterization. Actually, following up on this, I have one last comment. I know you did already a lot of robustness on like the measurement of transition and physical risks. There is this one paper, I think maybe you already tried it, but I think they have a really cool approach to measure climate exposure. It's the one by Sautner and co-authors who use these earnings conference calls and basically try to identify different types of climate exposure. I think they also have a regulatory and the more physical ones. Yeah, maybe you could try that as well, or maybe you have already tried, so that would just be one additional comment.
Yeah, thanks for that. In fact, we have already tried to look at the correlation between our climate risk exposure and those attention-based indicators. Actually, for our sample of financial institutions, we find a quite low correlation between both. I think the correlation is positive. Maybe Quentin can confirm that, but in any case, it is quite low. So we think our exposure, our market-based measure have some advantages in comparison with attention-based indicators because they are more directly related to the potential financial outcome. So for trying to measure systemic climate risk, I think it might be better to use market-based measure. But it's true that it's intriguing that we cannot find higher correlation coefficient between the two indicators.
Excellent. So I think I have to wrap this up. We're already out of time, but this has been really fantastic. Very interesting paper, great presentation. So thanks so much, Tristan and Quentin, for the presentation. And thank you all for joining today and for your questions and comments and engaging with us. So at the end, let me just announce our next webinar, which will take place on March 10. Kim Kramer from the LSE will present his paper, When Private Firms Provide Public Goods, the Allocation of CSR Spending. So I hope to see many of you there. And with that, I wish you a great start into the new week. Thank you.
Thank you so much.
Thanks a lot.